Greetings, members, one and all of the Salivation Nation. Does gold have a clear path to $2,000? And what about silver? Will it follow its coattails and soar up to 40%? Let's explore! This first article comes to us from MarketWatch, talking about today's price movements in gold. Relatively slight, but it is up. And as you know, recently talked about how gold was down because of the pushing of a stronger dollar. Well, now their traders are tracking a weaker dollar, and gold is pushing back. And, that seems to be the case. It's a push and pull of these prices for sure. And it's always kind of a yo-yo or a seesaw of what's going on. But really, gold has held its own for the most part. And silver it's not doing terribly bad considering where it was in just a few weeks ago at under $12 an ounce. Here in this MarketWatch article says gold futures ended higher on Tuesday with slight support attributed in part to a weaker tone for the U.S. dollar as traders bet on a slow economic recovery, even as efforts were underway to reopen economies that were closed to contain the COVID-19 pandemic. It appears a safe haven bid has returned to the precious metal amid changing marketplace notions regarding the pace of economic healing after COVID-19 pandemic has subsided, said Jim Wyckoff, senior analyst at Kitco.com, in a daily commentary. And that may be the case, but there's another aspect that I will throw as sort of a cog in the wheel of all this, because as we are starting to see some things opening up, I'm hearing some reports of like some restaurants opening up with no restrictions apparently, or with limited restrictions on social distancing and what have you, and they are packed. And that could just be the very beginning momentum. That could subside very quickly. But a lot of this is psychological. You may hear stories, anecdotal stories of restaurants and facilities that are opening up being packed, but that may only last for a little bit, as I tend to believe those that think this is going to take a while to recover. But nonetheless, it's mostly psychological as far as how the economy is being viewed in this case, or as far as the movement of prices from one day to the next. But I believe because when the reality sets in on this recession and how deep it will be and how long it will take for us to get out, that's going to bode well for gold in the long term. The article continues, traders and investors are assessing the market's ramifications of a very possible second wave of the COVID-19 pandemic as major global economies start to reopen their businesses and transportation infrastructure, he said. There is a growing sentiment that economic recoveries, which have been factored into current market prices through solid rallies in many global stock indexes, will be slower than initially expected. And that is a real thing. There's a real fear of this second wave. We don't know how serious it's going to be. I think most do expect that there will be one. Hopefully we'll be better prepared by then, because I think this virus took us all by a storm at the very beginning, and every nation pretty much underestimated the severity of it as we learned more about it, especially how contagious it is. If marketplace notions continue to shift to slower economic recoveries, it's likely that many markets, especially the stock markets, will have to do some serious repricing to the downside, Wyckoff said. That would provide more support to haven gold. Gold for June delivery on COMEX rose $8.80 or 0.5% to settle at $1,706.80 an ounce, following losses in each of the two sessions. July silver added 2.9 cents or 0.2% at $15.70 an ounce. We're going to take a look at those prices here in a moment. But first here, the U.S. dollar index was down 0.26%, a measure of the currency against a basket of six major rivals, was down 0.3% as gold futures settled Tuesday. A weaker dollar can be a boost for commodities priced in the unit, making them less expensive to users in other countries. And let's take a look at where the prices are now. We can see that gold is up slightly and silver is down slightly. Platinum and palladium are both down a little bit more. But that just shows you, very interesting. But silver is maintaining levels above $15.50 for sure. But it also gives more credence to gold being that ultimate safe haven, and people starting to put their resources there when the dollar confidence is a little bit lower. Chris Gaffney, the article continues, president of the world markets at TIAA Bank, said that the rise in gold prices may continue even if the economy makes a swift recovery or a swift sneeze that is non-COVID related. Thank goodness. As economies recover, support for gold prices will shift from safe haven buying due to fear of COVID-19 to buying due to fear of inflation and uncertainty surrounding the massive amounts of liquidity central banks have created, he said in an email commentary. All right, very good. So that is kind of where things are. And you know, when inflation and uncertainty surrounding the massive amounts of liquidity, when that really sets in for some of these people who maybe aren't paying attention or buying some on the electronic markets or exchange traded funds, you know, we're going to see it possibly go up more. And then if gold goes up to $2,000, which I do believe it is on that clear path, we may see levels or times when gold does go back down, little dips here and there. But those little dips will be temporary, just like we saw yesterday. Then I think we will see it continue to climb up. I'm pretty bullish on gold. Silver's a little harder. Now, there's people making some pretty bold predictions here. This is David Lynn from Kitco, who has replaced Daniel Camboni to interview folks there at Kitco, who is off on maternity leave. But he says that silver prices to soar 40%, according to an analyst here. Silver prices are poised to break out to the upside in the magnitude of over 40%, owing to fundamentals created by COVID-19 and to an excessively high gold to silver ratio that is expected to mean revert, according to Nathan Rhines, writer for Seeking Alpha. Technical charts show that the gold-silver ratio now stands far above the historic average, with a reversion to the mean soon being a certainty, Ryan said in a recent report. Although, I tell you, that is interesting analysis that he says that it's pretty much a certainty. To be sure, the ratio can vary significantly, but for over a century, it has averaged around 60 and has spent the overwhelming majority of the time in the 30 to 90 range. On 2 prior occasions, the ratio approached 100, but it never crossed that milestone, the report said. That's true. The gold to silver ratio, a measure of how many ounces of silver it takes to buy 1 ounce of gold, currently stands at 109.61, probably a little bit more than that now. Rhines used the metals perspective exchange traded funds to calculate how 2 metals compare to their historic means. The ratio of the SPDR gold shares and iShares silver ETFs is now a record 3.5 standard deviations from the mean, the report said. It's clear that silver is on sale. Yeah, that's for sure. That's one way of looking at it. A regression back inside the 3 sigma bound within a few months is almost a slam dunk. Pulling back the 2 sigma by the end of the year is reasonably likely, and a pullback of the 1 sigma line in 2 years, that's technical analysis talk. A reversion to the standard deviation mean, the historical mean would imply a price target of a SLV at 1979, which would be a 38% increase from levels of 1438. A reversion of the algorithm mean would imply a target of $24.09, which would be up 67%. Rhines documents historical performance of silver during periods of financial crisis. He's suggesting that in periods of financial and economic uncertainty, the precious metals shine. That's true. I believe we now find ourselves in such times. The financial crisis of 2008, gold was the first mover, but silver soon followed and eventually surpassed gold in relative terms. That pattern may be repeating. It would be a reasonable assessment to think that would be the case, but I'm going to give some caveats here. I want to see what the rest of this is about before I give those caveats. The precious metal rose as inflation hedges is eclipsed by their standing as safe haven assets during financial environments or uncertain financial environments. He thinks it's safe to say that the current environment qualifies as such a scenario. While no analogies are perfect, a look back at the lessons of the financial crisis and its aftermath provides a useful context for today. During the last financial crisis of 2008, silver doubled in under the first 2 years, then doubled again in 7 months before retracing from its 2011 highs. While both gold and silver should do well during a recession, silver is expected to outperform owing to its higher sensitivity or beta. SLV has a beta of 1.46, and it talks about that in regards to GLD and the SLV. Ryan's view is that silver would perform well during the current financial crisis differs from that of other financial analysts who see silver's performance during market downturns tied more closely to base metals. Phil Stribel, chief market strategist at Blue Line Futures, noted that there is a strong correlation between the equities and silver, as shown in the charts below. If you show a chart of the S&P 500 and a chart of silver, they look too eerily similar, which tells you there's that demand concerned over the demand picture from the industrial side of things, Stribel told Kitco News in a recent interview. Analysts at Refinitiv have also noted that when looking at several recessionary periods, and not just at the one in 2008, one can deduce that silver has not always performed well during a recession. So I'm glad they're balancing this out and showing that for sure. There's been talk here also from a webcast that there's past 7 U.S. recessions since '69. Gold has seen an average gains of around 23%. During the past recessionary periods, combined silver's only gained an average about 1%, Refinitiv said. So silver, this interesting metal, certainly is something to be, it's wowed us. But it's also surprised us. It's disappointed us. And so that while I'm probably somewhere in the middle, I don't think it's going to perform just around 1%. But I don't believe it's going to do what it did in 2011 after the aftermath of 2008. That was a very unusual situation, and that was exacerbated not only by the recession, but also supply and a bottleneck production and in that unprecedented demand during that time. How will that play out this time? Who knows? We are producing more silver now than we did back then. And we have to also think about, in the times of increasing industrial usage for silver, that will be in the past since the 2008 crisis, that is going to be scaled back, obviously, not only when things come back together online, but also the lack of demand just because there's not going to be as much economic activity for the base metals, and most of silver that's produced is as a secondary metal to the base metals. So I believe you're going to have the push and pull in that direction as well, where I'm bullish to silver to some extent, but not to the amounts that we saw where it went down to 32 to 1. I believe we can hope for maybe 50 to 1 in due course, but that's going to take a lot of demand for folks like you and me stacking silver out there and getting new stackers on board for it to ever get to that point. I believe it's wise to stack silver, but I also have been telling folks and have been practicing myself diversifying with more gold. I believe gold is the ultimate hedge against economic instability. Even though I do feel silver is a hedge as well, it is a more volatile hedge. So there you have it. Post your thoughts below. I'd like to extend a multitude of gratitude to you all for taking the time to watch. Remember, I post a video daily, and I want to encourage you to rate this video. Please thumb up or thumb down the video, whichever if you liked it, thumb it up. If you didn't like it, thumb it down. And comment and share the video and subscribe.